Welcome to another session, class. Today we are going to be working and going through the financial management exam. So for those taking the ICAG and the ACCA, this is certainly for you. So it's going to be an interesting class. Let's dive right into the information as we always do. So let's start with the objectives for today. What will be the objectives for today? So first of all, we would need to understand what financial management is. I'm always for having a proper foundation. So let's understand what financial management is. We are going to understand what financial planning and ratios are. Ratios is one of my favorite topics, and we would be trying to understand to an extent what ratios are and some of the key ratios. Then we would also understand management incentives as well. Management incentives, very important. Very important to understand management incentives. And then we'll be talking about non-profit organizations and how they measure performance and management of resources. So we'll be talking about value for money. So let's go into the slides. It's going to be an interesting session today. So when we say financial management, it's pretty simple, right? It's simply the management of finances, the management of finances. But it has a higher goal, You are basically doing that. You are managing your finances to achieve the objectives of the organization, So the normal assumption when it comes to financial management is for private organizations or the private sector who are more into profits and are profit-driven is to maximize shareholder wealth. So anytime you think about financial management, please think about this, that financial management is all about management of the finances of the organization. The organization has a limited amount of resources, and so it has to manage it. If it had an abundance of resources, limitless resources, then, certainly there'll be no need for management. Management comes in because of the limited amount of finances they have. So it's about proper management and allocation of resources and finances where they are going to yield the most value. Okay. So once we've understood that, we've understood financial management. Financial management cannot exist without financial planning. It cannot exist without financial planning. So the whole goal of financial management is to plan, to ensure that funding or money or finances is available at the right time, to meet the needs of the organization. Every organization has short-term needs, medium-term needs, and long-term needs. So it's all about managing the finances properly so that you can meet those medium, short, or long-term needs, basically. So that will be the goal of the financial manager. The financial manager should be skillful in planning in that regard. So in the short term, what would they need funds for? What would an organization need funds for? In the short term, funds may be needed, to pay for inventory purchases, So things to do with working capital, So things around your inventory, your receivables, your working capital requirements. You need money, to fulfill your day-to-day operations. That's what we mean by the usage of working capital. To fulfill your day-to-day operations, you certainly need funds. So in the short term, you need funds for your working capital requirements or your day-to-day operations. In the medium and the long term, things like the purchase of non-current assets, it's a more long-term objective. The reason why it's long-term is because the yield and the benefits that accrue to the organization have a long-term impact. And basically the investment into it is a lot more huge. So for example, if you are going to buy a non-current asset, let's say a property, the investment is usually a lot more huge. So the organization in its long-term needs should plan for purchases of non-current assets. So that's a typical example, such as plant and equipment. And so the financial manager must ensure that finances or funding is available to meet those needs. Very, very key. Very, very key. So financial management is all about decisions. Decisions. And the financial manager makes decisions relating to investment. I call it, there are three of them. I call it DIF, D-I-F. So dividend decision, investment decision, and financing decisions. So let's talk about investment decisions, right? Investment decisions is more of the purchase of non-current assets. You are investing into capital expenditure. You are investing into huge projects, basically into non-current assets. Basically, that you have an intention of generating revenue for you in the future. So the financial manager makes decisions relating to investment. Very, very key. Very, very key. Then the financial manager, also makes decisions relating to financing. The financial manager must finance certain projects as well. Finance certain things that they, might have purchased, Financing, paying for things, financing things. That's another goal of financial management. There's also the dividend decision. Remember that anytime an organization makes profits, right? They can decide to do two things. First off, they can decide to reinvest these profits back into the business, or pay it out to shareholders, or do a combination of both. So as part of financial management, dividend decisions is important. Should we pay our dividend? What would paying our dividend signal to our shareholders? So that's also another component or another decision when it comes to financial management. So always remember DIF, D-I-F, dividend decisions, investment decisions, and financing decisions. So very, very key. Very, very key. So financial management is also concerned with the management of short-term funds and with how funds can be raised over the long term. So when we talk about financing, financing decisions, like I said, it also involves capital raising, how you are going to pay for things. You need money. You need to raise capital in order to pay for things, or to fund projects, or to fund certain payments that you need to make. So financing is more about capital raising. Investment is more about purchase of non-current assets. And dividend decisions is more about your payouts to shareholders for investing into your organization. So I hope it's clear. Yeah. Then let's move on to management accounting. Let's understand management accounting, financial accounting, and financial management. Like, what's the difference? What's the difference, and how do these three things interplay? So when we talk about management accountants, basically, they provide internal information, internally used information. The financial accounting function provides external information. So anytime a management accountant builds a report or creates a report, it's for internal use. So things like variance analysis, all those things are for internal use. And there's also the financial accounting bit, which is for external use, so that users of the financial statement can also make their decisions. So that's very, very important. One is internal, the other is external. Very, very key. A typical example of a management accounting report is like a variance analysis report, where you are looking at, your actual performance versus your expected performance to understand where the variances might be. It's very, very key. Very, very key. Another thing you should know in comparing financial accounts to management accounts is financial accounts, they detail the performance of an organization over a defined period. That's why you see the financial statements prepared for a period, because they are looking at a period. But for management accounts, they are used to aid management to plan. It helps management to make decisions internally. Another difference is that limited companies are by law required to prepare financial accounts. You are required. Limited companies are by law required to prepare financial accounts, but there's no legal requirement to prepare management accounts. It's an internal thing. Also, you need to know that the format of a published financial account is determined by the accounting standards. For those who are writing financial reporting, we discussed IS1, which is the presentation of the financial statement. So there's a format, there's a way to present the financial statement that is determined by the accounting standard, But when it comes to management accounts, it's entirely at management's discretion. There are no strict rules regarding how to prepare or present the financial statements. Then financial accounts also focus on the business as a whole, entire business as a whole. That's what financial accounts focuses on. But management accounts can focus on specific areas of the organization. Another thing you should know is that financial accounts are of monetary nature. It's monetary nature. But the management accounts, it's possible to incorporate non-monetary items or non-monetary measures, basically. So these are some of the differences between financial accounts and management accounts. There's a last one I need to give you, which is that financial accounts present, a historic picture of past operations. It's in the past. But management accounts are both a historical record and a future planning tool. Remember that management accounts is all about driving decision and decision making. Financial accounts look into the past, management accounts look into the future. Very, very key. Very, very key. So let's look at financial objectives and its relationship with strategy. In case you are taking strategy, I have videos on strategy. In case you want to understand strategy a lot more, you can just look into this YouTube channel and you can try to understand strategy a lot more. But strategy basically is defined as a course of action, which includes the specification of resources in order to achieve a specific objective. So it's a course of action you are taking. Very, very important. Very, very important. So when we are talking about strategy, you are talking about a long-term plan. Very, very key. Corporate strategy, on the other hand, is also concerned with the overall purpose and scope of the organization. When we say corporate strategy, we are looking at it specifically from an organizational level and how value will be added to different business units of the organization. So we are looking at the organization in its entirety and breaking the pieces of the organization and seeing how value can be added to these different parts. Very, very important. Very, very key. Then let's look at, basically we've talked about corporate strategy. So what will be corporate objectives? I'm sure you have an idea here. So corporate objectives are those which are concerned with the firm as a whole. The objectives should be explicit, quantifiable, and capable of being achieved. Always remember in our strategy class, we talk about SMART objectives. And the objectives should relate to the key factors for business success. So it should relate to things like profitability, market share, cash flow, growth, customer satisfaction. The objectives should relate to the key performance indicators, the factors that are necessary for business success. The objectives should definitely relate to that. And we've mentioned some, which are profitability, market share, cash flow, customer satisfaction, etc. Let's talk about financial objectives. So financial targets, objectives may include targets for things like earnings per share, dividend per share, gearing, for example. When you say gearing, we're talking about debt or leverage, things like profit retention, operating profitability, etc. This is very, very important to understand. So like we said, the usual assumption in financial management when it comes to the private sector is the maximization of shareholder wealth. So when we talk about the maximization of shareholder wealth, what do we mean? It means that we are trying to increase the value that we give to shareholders. So the wealth of shareholders comes in different forms. It comes through the market value of the share. So for example, if you buy a Microsoft share for, let's say, $5 and it increases to $6, that's increase in value. Then it also comes in another form, which is dividends. That's also shareholder wealth. So a shareholder's return on investment is obtained in the forms of dividend received and capital gains from increase in the market value of shares. Two components. Please don't forget this, because this is critical when you're calculating shareholder return. Dividends plus capital gains. Very, very important. So when we are looking at total shareholder return, we are looking at, like I said, dividends plus the increase in share price or capital gain. So it's basically your price at the end of the period, which is P1, minus your price at the beginning of the period, which is P0 or P0, plus your dividend that is paid, all divided by your share price at the beginning of the period. So P1 minus P0 plus D1, all divided by P0. But let's look at an example, right? An example will definitely help us to understand. So a shareholder purchased 1,000 shares in a company called SJG Company on 1st January at a market price of 2.5 per share. On 31st December, the shares had an ex-dividend market value. So when we say ex-dividend, it means ex-dividend, which means after dividend. Ex-dividend, after dividend. Ex-dividend market value after dividend, or after dividend payment market value of 2.82 per share. The dividend paid during the period was 0.27 per share. What is the total shareholder return? And what are the elements of total shareholder return? Very, very simple question. So first off, we need to understand what is P1 here. P1 is the price of the share at the end of the period. So what's the price of the share at the end of the period? We are given that on 31st December, the shares had an ex-dividend market value of 2.82. So we have that 2.82. You can see right there in the slide. Then we need to take out the price at the beginning of the period, which is on 1st January. On 1st January, the share price was 2.5. Then we need to add the dividend paid. What is the dividend paid here? The dividend paid during the period was 0.27. So we add that. Then we divide all of that by the price at the beginning, which is P0, which is also 2.5. And therefore, we have 24% shareholder return. 24% shareholder return. Very, very key. But the question also tells us that we should, what are the elements of the total shareholder return? Remember that we said the total shareholder return comprises of dividend plus increase in share price. Dividend plus increase in share price. So let's look at the increase in share price or the capital gain. The increase in share price bit is the P1 minus P0 over P0, which is the increase in share price, right? The price at the end of the period minus the price at the beginning of the period divided by the price at the beginning of the period. That will measure the increase in share price or the capital gain. So that will be 2.82 minus 2.5 all divided by 2.5, which gives us 13%. 13%. And then we move on to the dividend side of things, or the dividend yield, So under the dividend yield, that one too, the formula would be your dividend paid divided by your price at the beginning of the period, which is D1 divided by P0. In essence, D1, we are told, is 0.27. Our price at the beginning of the period, which is on 1st January, we are told is 2.5, which gives us 11%. When you add 13 to 11, you get 24, which is our initial calculation we had. So that's a very, very simple breakdown, when it comes to the elements of the total shareholder return. Very, very key. Very, very key. Then we move on to profit maximization and EPS growth. Profit maximization. What is profit maximization all about? What is profit maximization all about? In a lot of economic theory, it is assumed that the firm behaves in such a way as to maximize profits. But there's a way the economist views profit, views profit. The economist views profit in relation to it as a reward for risk-taking. A reward for risk-taking. So when you take risk, then you are able to make profit, or what the economists will call normal profits. But accounting profits are quite different, right? Accounting profits, to a large extent, can be manipulated by the choice of accounting policies. A choice of accounting policies. So we have economic profits, we have accounting profits. Accounting profits can easily be manipulated. Economic profits is seen more in relation to as a reward for risk taking. It's a reward for risk taking. So let's look at EPS growth, or EPS. How do you calculate EPS? First of all, which is earnings per share. Earnings per share is simply calculated by dividing net profit or loss attributable to ordinary shareholders, not preference shareholders, ordinary shareholders, you divide that by the weighted average number of ordinary shares. Ordinary shares. Ordinary shares. Very, very important. So earnings per share is a widely used measure of performance. A company must be able to sustain its earnings in order to pay out any dividends. So investors are always on the lookout for EPS, or earnings per share, or earnings growth. It's a very, very key. See, I said key. It's a very, very key indicator of an organization's performance. But let's move on to EPS growth. EPS growth, and let's look at a simple question. I'm all for questions so that you can grasp exactly what is happening. You can grasp exactly what is happening. I'm all for questions. Okay, so the Grasshopper made earnings attributable to shareholders of 8.25 million in 2008 and 8.88 million in 2009. The company's share capital was 12 million ordinary shares of $1 each in both years. Calculate the EPS for 2008, 2009, and EPS growth in relative and absolute terms. Very, very simple question. So first of all, we need to understand the earnings attributable to shareholders. In 2008, it was 8.25 million. The number of ordinary shares within that period was 12 million. So our EPS, or earnings per share, would divide 8.25 by 12 million, which will give us 68.8 cents. Then in 2009, we have earnings attributable to ordinary shareholders of 8.88 million. We have number of ordinary shares, 12 million, which gives us an earnings per share value for 2009 of 74 cents. So what will be our earnings per share growth? Our earnings per share growth will be 74 cents minus 68.8 cents, which gives us somewhere around 5.2 cents. 5.2 cents. And our earnings per share growth would be that 5.2 divided by 68.8, which is our initial earnings per share in 2008, which gives us 7.6%. So our earnings per share growth will be 7.6%. It's a very basic example, very simple example, very easy to understand once you know the formulas. Now let's move on into other financial targets. In addition to targets for earnings and EPS, a company might set other financial targets, such as dividend per share, which is dividend, like dividend per share. So dividend over your number of shares. You have your gearing, you have your operating profitability, etc. etc. I decided to add a comprehensive example on EPS growth. I thought I might help you. So let's look at that example. So Lion Grange Company has recently introduced a formal scheme of long-range planning. Sales in the current year reached 10 million, and forecasts for the next 5 years are 10.6 million, 11.4 million, 12.4 million, 13.6 million, and 15 million. The ratio of net profit after tax to sales is 10%, and this is expected to continue throughout the planning period. So this is more of a question on planning, a planning question. Total assets less current liabilities will remain around 125% of sales. Equity in the current year is 8.75 million. It was suggested at a recent board meeting that if profits rise, dividends should rise by at least the same percentage. Number 2, an earnings retention rate of 50% should be maintained. That is a payments ratio of 50%. Number 3, the ratio of long-term borrowings to long-term funds, which is debt plus equity, is limited to 30%, which happens also to be the current gearing level of the company. So what are you required to do? You are required to prepare financial analysis of the draft long-range plan. Very, very important. Okay, so first off, to build this plan, you need to know that it's a 5-year plan. So you need to put year 1, year 2, year 3, year 4, year 5, right? So our sales is given in the question. The sales value here is given in the question. So if you go back to the question, you see that our sales value has been given right here. See, 10 million, 10.6, 11.4, 12.4, 13.6, 15 million. It's all given right here. So this portion tells us our sales. So that's what we start with, right? That's where we start. So once we figured out our sales, let's move on back to the question, to the solution. Once we figured out our sales, we need to know the question give us the net profit after tax, the net profit after tax. So how do we get our net profit after tax? The net profit after tax, it says the ratio of net profit after tax to sales is 10%. So this 10% is going to be our basis for our calculation. This 10% here. The ratio of net profit after tax to sales is 10%. So let's look at it critically again. Let's look at it critically. So what it will mean is that we need to multiply 10% by our sales. If you multiply 10% by our sales, then we are going to get our net profit after tax. So you can see that's exactly what's happening here. If you multiply 10% by 10 million, you get 1 million. If you multiply 10% by 10.6 million, you get 1.06 million. Multiply 10% by 11.4 million, which is, all these are sales figures, you get 1.14 million. So multiply 10% by the sales figure for each year. You should get the answer. Very, very key. I hope you are with me. Then you also have dividends, which is 50%. The question tells us that it's 50% of profit after tax. That's a huge dividend payout. So it tells us here, see, maintained a payment ratio of 50%. So very, very important to step by step. I'm going to take you through this financial management paper. So 50% of profit after tax. So you multiply 50% by the profit after tax numbers. So you should be getting, first the current year, 0.5, 0.53, 0.57, etc. Like that. I hope you are following. Then we also have our total assets less current liabilities. We need to figure that out as well. So let's go to the question. I think the question gave us some information. Total assets less current liabilities will remain around 125% of sales. So you need to multiply the sales figure by 1.25. See, it's giving it to us here, 125% of sales. So you need to multiply them 125% of sales. So 1.25 times 10 million. So 125% times the sales. 125%. That's what the question says, right? The question says, if you go back to the question again, it says 125% of sales. So you need to multiply. You need to multiply 1.25 by 10, which is 125% of the sales figure. So if you do that successfully, you get 12.5, 13.25. Just multiply that by the sales figure. It's already given to you in the question. Then you move on to equity. So how do you come up with the equity values? This is very, very important. How do you come up with the equity values? So the question must give us a clue. It says equity in the current year is 8.75 million. 8.75 million. So you see that here, right here. It's 8.75 million here. Yes, so I expect that our equity value should be also be 8.75 million. Very, very key. So let's go down and see what's happening. Yeah. Let's go down and see what's happening. So you have 8.75 million. So you see, you can see right here. So one of the things you should know that this equity value, the question told us that it is increased based on our retained earnings. So it says if profits rise, it's B, an earnings retention rate of 50%. which is our retained earnings, right? Retained earnings value. So our equity should increase based on the same rate. So that's how come you have all of it here, which is, you can see 9.28 is increasing by the retained earnings. You have 9.28, you have 9.85, you have 10.47, etc. Then you have debt, maximum debt. You know, how do you calculate debt? That's also a tricky one that you need to understand. How do you calculate debt? If you go back to the question, you see that our debt to long-term funds ratio is 30%. So what does it mean for equity? It means our equity is 70%, right? 70%. So what it means is that if we say 30, we can just put out the formula, which will be 30 over 70 times the equity value. Don't forget that the debt on long-term is 30%. If the long-term is 30%, then the equity would be about 70%, because debt plus equity is equal to, you know, basically the funds of the business, the total funds of the business. You know, as you can see in the question, it says long-term funds equal to debt plus equity. So 30 divided by 70, 30 representing the debt amount, 70 representing the equity amount, times the equity value should give us the maximum debt. So you can see here. You see, please take note of this. Please take note of this. Please take note of, you see, 3 over 7, which is 30 over 70. 30 over 70, which is 3 over 7 times equity. So that's giving you this 3.75, 3.98, 4.22, etc. So you see how it's working, you know, beautifully. It's working beautifully, you know, working beautifully. So your funds available then would become, you need to add your equity plus your debt, and you get your funds available. And when you add them, you should be getting the values below: 12.5, 13.26, 14.0, etc. So based on that, now you can calculate your shortfall in funds, right? You can calculate your shortfall because you know, first of all, you know your total assets less current liabilities value. You know that. And you also know your funds available. Your funds available. So once you know that, you can easily do a quick deduction. So if you take, for example, the current year, the total assets less current liabilities is 12.5 million. The funds available is 12.5 million. So there's a zero shortfall in funds. You know, very, very important. Very, very important. So how do we calculate shortfall in funds? Just in case you want to know that as well. Yeah, I think that was a good question. So to calculate shortfall in funds, someone might be asking, how do we calculate shortfall in funds? To calculate shortfall in funds, it is simply your funds available here. Your funds available, you compare your funds available here to your total assets less current liabilities here. Very, very simple. Very, very simple. Very, very simple. I hope you are following. I hope you are following me. So is this funds available, right? Minus your total assets less current liabilities. So if this is A, funds available is A, and total assets less current liabilities is B. It's A minus B. A minus B. So that's why, for example, if you go to year 5, the funds available is 17. The total assets less current liabilities is 18.75. So what do you have? You have 1.75. Pretty simple. So yeah, that's a comprehensive question that I decided to throw in just to help you guys understand how to do some financial planning. So let's look into non-financial objectives. So there are also non-financial objectives, right? You know, the goals of an organization is not only financial. So an example of non-financial objectives will be like the welfare of employees, the welfare of society, the fulfillment of responsibilities towards customers. All those are non-financials. Other typical examples are diversification, leadership in research and development. One thing you should notice is that non-financial objectives do not negate financial objectives. They do not. But what they expose is that the simple theory of finance that says the objective of a firm is to maximize shareholder wealth is quite narrow, right? Apart from maximization of shareholder wealth, you know, there are other objectives as well. You know, and sometimes organizations have to find a balance between financial and non-financial objectives. You know, maximization of shareholder wealth is a financial objective, you know, but there are also non-financial objectives. Like, for example, the welfare of your employees. It's not necessarily financial, it's not financial, but it's a non-financial objective. And if you achieve that non-financial objective, employees will be motivated to work harder, which will in turn improve your financial objective. So organizations need to find a balance between the two. In my strategy class, I talk a lot about stakeholders. So you can go into this YouTube channel and you see all the videos on strategy. But basically, I talk about stakeholders. So if you haven't subscribed to this channel, if you haven't liked this video, please do just subscribe to this channel and hit the notification bell so that anytime I post a video, you'll be certain to get it. Please do that. Just subscribe, hit the notification bell so that you always get your lecture videos. So that, because I want you to prepare and pass for this without resitting. So hit the notification bell, hit the subscribe button so that anytime I post a video, you'll be the first to receive it. You can watch it, you know, and learn from it, you know. I want you to pass it. So stakeholders are individuals or groups who are affected by the activity or the strategy of the firm. They could be internal, they could be connected stakeholders, and they could be external stakeholders. So stakeholder groups are divided into 3 categories. You have internal, you have connected, you have external. So the internal stakeholders, you have people like employees, managers, directors. Then the connected stakeholders, you have shareholders, you have customers, you have bankers, you have suppliers, you have competitors connected in some way to the organization. Then you have external stakeholders who are government, pressure groups, you know, professional and regulatory bodies, etc. You know, like I said, in my strategy videos, I talk a lot more about stakeholder and stakeholder mapping. So what are some of the objectives of stakeholder groups? Some of the objectives. Every stakeholder has their own objectives or their own interests. For example, for shareholders, they are more interested in maximization of their shareholder wealth. For creditors, you know, they are more interested in, you know, the creditworthiness of the organization, getting their money back. For employees, they want job security. Employees are out for job security and salaries and benefits. You know, if you are going to work for an organization, you want salaries and benefits, right? For management, they are also employees, so they also want bonuses, they also want rewards, they also want job security. Very, very important. Very, very important. So we'll be delving into measuring financial performance or measuring the achievement of corporate objectives in our subsequent video. But I would like to bring this lecture to an end in the subsequent video, which will be on this YouTube channel as well. I'm going to be talking about measuring financial performance because I want to take my time to go into ratios and ratio analysis. So I want to take my time to go into that. And I hope you enjoy this lecture. Please hit the subscribe button. Hit the subscribe button, smash the notification bell so that anytime I post a video, you'll be the first to get it. And again, you can join our WhatsApp group. All these slides and study material are for free. You can join this group and our WhatsApp group, and you should be able to get it. Thank you and have a good day.